And we will get started in just a few minutes. One thing that I would love for everybody to do is obviously, as Intel has been having difficulties, I've noticed that our numbers have dropped significantly in this meeting. And so if you want to see the long-term growth of this club, if this club has brought information or insight to you, please turn around and share it with a few friends. We are public and we're open. So you reaching out to somebody who might be interested in passive investing is the best way to spread word of mouth about this club. And I would really appreciate it if you guys did that. Our numbers have fallen a fair amount here recently, and we need to work them back up. And so I'll be on social media. I'll be doing networking in order to boost the numbers, but it would mean a lot to me if you took a moment and invited a few people that you think might be interested in coming. All right, and it's 12:05, so I guess we will officially kick it off here as more people are coming in. If you're new and if you just joined, go ahead and stick the state that you're from inside the chat. It's always interesting to see how many people are in the standard Intel fab locations and how many are outside of that. All right. Well, first of all, I wanted to say that the Finial group here is our fifth and final club fund speaker for the year. We now have 5 different groups with which our club's fund is going to place investment, and all of them have interesting business strategies. This group is a industrial aggregation venture fund. When I was reviewing them, two different funds really stood out, and Finial Group was one of them. So I wanted to bring them in here and to get everybody's feedback on their particular proposal. And we will kick it over to them in one moment. Dennis, I don't know if you want to do this or if there's another person, but next week I'm going to be traveling to be with family, and I need somebody to take over not mentoring, moderating this call, and to be the person to come and greet the speaker and look at the questions that are in the chat and ask the questions. So go ahead and DM me if you are interested in doing that. And it doesn't have to be somebody who's done it before in the past. Anyone is welcome to do it. And I will probably not be attending next week.
Next Friday, unfortunately, I can't make it. Sorry.
Oh, okay. We'll find somebody then. And the other question is that the speaker for next Friday actually booked next Friday and 2 weeks from now. And so I cleared it up with him, and they said that they were going to be speaking 2 weeks from now. So we actually have a spot where I need to find a speaker and bring a speaker in. The speaker that's going to be here in 2 weeks actually offered to go to his network and bring a speaker in. But I know it's long overdue to have a club discussion also. And so I'm going to run a little informal poll right now before we get started. If you would like to have a club discussion, which means that there's no speaker, it's just the members of the club showing up and talking about whatever topics they want. I won't be there, so I won't be dominating the conversation like sometimes I do. And so that's option number 1. Option number 2 is we go ahead and we find a speaker and bring the speaker in. So go ahead and put into the chat whether you're interested in option number 1 or 2, just by saying 1 or 2. Thank you, Ryan. Oh, I see you direct messaged me. Ryan says he'd be happy to host. I appreciate that.
Yeah, you need somebody, happy to do it.
Sounds like so far our club discussion is taking it. Okay. Well, we'll make it a club discussion, and I won't be there, so you can, say things. All right. With that, we're going to turn it over to Keith and the Finial Group. Keith, welcome to the Alternative Investing Club.
Awesome. Thank
We
you
are
guys.
honored to have you here.
Yeah, thank you guys for having me, and thank you all for taking the time to jump online today. We're excited to tell you about what we're working on. I'm Keith Bilsky, founder and CEO of Finial Group. Also presenting with me today is Dylan Shopper, managing director, and Zoe Pollock, vice president of investments here. So the three of us are three of the four members of our investment committee, and I'll explain more about that as we get further into the presentation. Dylan and I both started our careers in commercial real estate investing a little over 20 years ago. And we were at another firm, which is where we met and became friends. I left that firm in January of 2010 to launch Finial Group, and was lucky enough to have Dylan join me a couple of years later. And he and I have really been working over the years to build our firm here. So we'll be almost 15 years old as a firm coming up in January. And so we're excited to tell you about our track record and what we've done since then.
All right, go ahead and kick off the presentation.
Perfect. So as a quick look at the table of contents of our plan for the day, we're going to start out with an overview of who Finial is and tell you a little bit about us as a firm. Then we're going to get into the details of our specific investment strategy and talk about the terms of this specific offering. And then we're going to talk a little bit about the target market overview and the pipeline. This particular venture already has some assets under contract, and so we've got some good news to share with you already. And then we'll wrap up with a summary and hopefully leave some time for Q&A so that we can address any questions you all may have. So I wanted to start by just explaining who Finial is. We're often asked where the name Finial came from. And when I was launching the firm, it was important to me to not just name it, my own after my own name, because I always wanted to bring in additional partners over time and really grow the firm to be something much bigger than me as an individual. So I started researching names that had some degree of symbolism, and came across and was drawn to the word Finial, really because of its symbolism of being the architectural apex at the top of a building. So maybe the most notable is at the top of the Empire State Building. Everyone knows that when they see it, they know that building. And like the Finial of a building, it's our firm's intention to really perform at a level above our competition and peer group. And so that's what we're always striving for. In getting to know Finial, I think it's important to point out that, we really pride ourselves on being a values-based company. And that's really based on three core values that we believe are critical in everything we do. So first of those is integrity, which to us means to always do the right thing, no matter what, even when it isn't the easy thing to do. We think that's very important in our business as a fiduciary raising capital. Secondly is service, which to us is to work tirelessly and just relentlessly to get results. And we've been able to do that over the last 15 years. The economy's had ups and downs along the way, and we've had our share of challenges to work through. And I think what you'll see as you dig into the track record of Finial is we're the kind of group that always digs deep and finds a way to win, sort of regardless of what the world deals us. And then last is innovation. And to us, that's really about discontent with the status quo. Generally speaking, commercial real estate investment is a little monotonous, and a lot of people just do the same thing and compete against each other. But I think what you'll learn as we get into this strategy is we're taking a different approach, and we're focusing in a different sector of the market than most. And that's really where we're finding so much opportunity. So in getting to know Finial, we're headquartered in Houston, Texas, which is where the three of us are sitting today. But we also have offices in Dallas, Texas, San Antonio, Atlanta, Georgia, and Nashville, Tennessee. So today we operate 5 offices across 3 different states. We have a handful of other markets that we've starred here with the gray stars that we're and have been in the process of really doing research on and building pipeline with plans of eventual expansion. But for the purpose of this specific strategy and this specific iteration that we're presenting to you today, it will really be focused on acquiring assets in the 5 markets we already operate, which is, again, Houston, Dallas, San Antonio, Atlanta, and Nashville. So here's a quick look at really the names and faces behind Finial. So at the top, you'll recognize the 3 of us that are sitting here today, and then one additional person, Reagan Bell, who is our Vice President of Asset Management. The 4 of us really make up the executive committee. So we're the ones that are really driving This fund, on a day-to-day basis, all four of us tour every single asset during the due diligence period. We're very involved from a material standpoint, and that's what we love to do. We travel a lot, making the rounds, seeing those properties. Below our four pictures are some of the names and faces that are scattered across the other markets that we operate, and they're really the boots on the ground that are making it all happen on a daily basis. So now for the fun part, we can dive in and talk a little bit about the strategy. Lots of firms invest in industrial real estate, so that in and of itself isn't particularly unique. But what most firms do as an investment company focusing on industrial real estate is they go out and they buy larger multi-tenant assets. So these are assets that might be anywhere from, individually from 10 to $100 million assets that are generally multi-tenant and already have kind of a rent roll. And that's really buying kind of a basket of goods that is what it is, right? Like you may like certain aspects of the credit of the tenants. You may like certain space that's within that project, but you also may not like some aspects, and you're kind of buying it because you think the deal overall is good. What's unique about our strategy is we approach it differently. So rather than going out and buying that large multi-tenant asset and just trying to optimize it, what we're instead doing is really building a portfolio, building by building and asset by asset. So we focus on this specific sector of industrial real estate that's the single-tenant freestanding assets. So these are smaller buildings that are typically last mile distribution or micro fulfillment kind of centers on the distribution side, or light manufacturing. The strategy really focuses on grouping three buckets of types of these assets. So first, we go out and acquire long-term stabilized assets, which are, to us, deals that have more than 4 years of lease term. So these deals are really providing kind of global cash flow for the venture. The second group is short-term value add. These are leases that may have 2 years or less remaining on their term, and they generally have a big mark-to-market opportunity, meaning that they're well below market rent in their current lease. And we view them as something that when that lease rolls, we have an opportunity to either renew the existing tenant at market rent or re-tenant that space to someone else and create value by doing that. And then the third bucket is assets that we buy that are vacant upon acquisition. And so these are deals that we believe we can lease and have immediate upside potential, and we're acquiring at an attractive basis that really helps drive performance and return for the venture overall. What's great about this strategy is we're really able to be thoughtful and intentional about diversification. And, that comes in a couple of ways. So first of all, geographically, as I mentioned, we're going to be buying across 5 different markets, creating a regional portfolio. What we like about that is it basically removes the correlation to any one specific market. So if you are buying all of these assets in Houston, Texas, Houston, whether we like it or not, tends to have some degree of correlation to oil and gas. You guys can all go get oil and gas exposure in a lot of different kinds of investments. You don't need to invest with us for that. So we're very thoughtful about making sure that we have these assets in different submarkets within different geographic areas, and that we build in diversification of our tenant base. And again, because we're selecting this building by building and tenant by tenant, and as we get into the pipeline, we'll talk to you about our process and how we have a really wide selection of buildings to choose from. We can be very thoughtful and intentional about making sure we're building the perfect mix of portfolio, really with the end in mind of knowing that our goal ultimately is to exit the portfolio to a large institutional buyer. And ultimately, that's what we're aiming to do, really. Is so we're going to be aggregating this portfolio, working to lease it up, maximize the occupancy and net income of the portfolio, and then finally exit in one large transaction to an institutional buyer. We have successfully done this in the past. So this is the 7th iteration of this strategy, and I'll dig into the track record a little bit here shortly, but you'll see that we've round tripped funds 1, 2, and 3, and those are entirely sold. Funds 4, 5, and 6 are still assets under management. And then this venture will be our fund 7. In looking at that and how those previous deals sort of went for us. So fund 1 acquired a little over $50 million in total assets. This was sort of the beta test where we weren't, we thought we were going to build more of a cash flow, kind of cash on cash style portfolio, and didn't know that we'd be able to create the kind of value we did. We originally actually were aiming for, in that venture, a 15% IRR. As we got into it, we realized how much value could really be created with these mark-to-market opportunities and lease-up of vacancies. And in that specific iteration, we were able to exit at a 24% IRR and an approximate 5 cap. And so, like in that case, Invest4 bought Fund 1, and they're an entity that would never go buy these buildings $2 million at a time, right? But we aggregated 20 of these buildings together at an acquisition value of 51, and we were able to sell it at a value much larger than that, generating a 24% IRR. So that got us obviously excited about the strategy. We quickly continued on with the second iteration, where we acquired a little over $30 million in assets. Did the same. We were able to lease those assets up and exit to a large institutional buyer. That one achieved a 25.35% IRR. Then next, in Fund 3, we continued on and we acquired a little over $40 million in assets. We were able to there achieve a 33.54% IRR. So what you'll notice is we consistently exceeded underwriting. We believe our current ventures are all on track to do so as well. We try to be conservative. We try to underpromise and overdeliver and never tell someone that we're going to go get something that's a stretch, only because then we don't want to have expectations that we can't live up to. So we're underwriting this specific iteration to a 20%, and we'll get back to that shortly. But again, you'll see we've mostly outperformed underwriting expectations. Funds 4, 5, and 6 are the ventures that are still assets under management. So in Fund 4, we acquired a little over $32 million in assets. In Fund 5, right at $30 million. And in Fund 6, $38 million. And so again, those are still all assets under management. Funds 4 and 5 today are virtually fully leased. They're both at very high occupancy. They are kind of in a state where we can sell those at any point we want. We feel like the current environment is not optimal for disposition. We feel like the capital markets are still a little choppy. So, and we have good assets that are well occupied. And so we're making quarterly distributions in those ventures that, everyone is very happy with. And we're really waiting for the optimal time to sell, which we're hoping will be Q1 of next year. Fund 6 just reached full deployment. So that iteration is still in the incubation process where we have some near-term rollover leases that we're waiting to market. So it'll probably be another year or two before that one is really in a position for disposition. The success of all these and the ability to continue to deploy capital in good assets is really what led us to the launch of Fund 7. So again, this is a venture that aims to acquire freestanding industrial buildings that are last mile distribution and light manufacturing. We're combining stabilized assets with value add. And we're also achieving diversification of both geographic diversification and industry of the tenant diversification, making sure we don't have exposure or too much exposure in any one specific area. And then finally, the goal of the venture is to do like we've done in the past, to exit in one large institutional sale, achieving cap rate compression. So the value creation is really twofold in that we're going to lease up the vacancy, mark to market those opportunities and maximize NOI. And then finally, we're going to exit to a large institution and achieve some cap rate compression. And we're really able to do that because we're buying in this very fragmented, inefficient market where these small $2 or $3 million buildings are owned often by people who may not own any other real estate other than their home. And it's a very inefficient market. The brokerage community is not very active in it. And we have a unique profile in that we have a vertically integrated business model. So we have our own in-house acquisition sourcing team. So these are people who light up the phones on a daily basis to find opportunities for us to buy. And that's important because in this very fragmented market, we're able to get these off-market deals at really attractive pricing. Also, as part of that vertically integrated strategy, we have our own in-house leasing team. So when we take these assets on and when we've acquired them, it's our own team that's focused on leasing them. We also have our own in-house property management team, which is managing it. And that's also important because we're not like a lot of GPs, that may use third-party service providers for all of these. We are not. We have Finial team members that are actually executing, and that's really our operational alpha. And that's what makes us unique, is it's our team, it's owners in the project, people that have their money in it right alongside yours, that are really care about the overall outcome. And over time, that business model has generated really great results for us, and we think it aligns interest in a special way. So with that, I'd like to kick it over to Zoe, and she can walk through some of the details of this specific venture.
Yes, so to talk a little bit more about our venture terms, we are targeting a total portfolio size of $36 million, which will be capitalized with $16 million of equity and $20 million of debt. We are estimating that total number of buildings in this venture to range from about 15 to 20 buildings for a total of about 300,000 square feet. Now, for our debt terms on this fund, we have obtained a $20 million debt facility from Woodforest National Bank, who is a repeat lender for us on 4 previous funds. So this will be their 5th time lending for us on our industrial aggregation venture. So they're very familiar with our process of this acquisition through this phase and the types of buildings that we're looking to buy here. Now, the way that this debt facility works is that at the time of the purchase of each building, we can essentially draw on this debt facility for the loan component of that building in order to purchase it. So each property will be purchased with its own individual note assigned to it that will have a 5-year term with 18 months of an interest-only period, and the loan amount will be a 60% loan-to-value ratio based on the purchase price. So the remaining 40% will be funded with equity. Our interest rate for this fund is based on the 5-year treasury rate plus 200 basis points. And this really floats at the fund level. But at the time that we purchase each individual property and it gets assigned its own individual note, the interest rate at that point in time locks in for that specific note for the full 5-year term. So this venture essentially is able to have fixed rate debt for all of the buildings within this portfolio. With this portfolio, all the properties purchased under this debt facility are cross-collateralized, and that really allows us to have flexibility with our debt components within the fund. And then also it really allows us to buy both occupied and vacant buildings into the fund. So because of that, we have to maintain a global debt service coverage ratio of 1.35, which means that all of the cash flows on the fund level have to be able to cover our debt by a 1.35 ratio. And the way that we are able to do that is really a key part of our strategy. So Keith briefly touched on it earlier, but we will kick off the strategy by first buying buildings that are considered long-term stabilized buildings so they can provide consistent cash flow for the fund. And once we have built up enough cash flow from those properties to exceed our 1.35 debt service coverage ratio requirement, that's when we're really able to start looping in our other 2 investment buckets of buildings, which are the short-term value add and the value add vacant buildings. Now, these last 2 investment buckets are where Finial is really able to implement our unique lease up strategy and property management skills to really create value within the portfolio and ultimately enhance overall portfolio returns. For this fund, we are forecasting an average stabilized cash on cash of about 9 to 10%, an equity multiple of 2.1 on the project level, and an anticipated project level IRR ranging from 20 to 21%.
All right, I have a couple of questions that I could jump in right now if it's a good time.
Sure, we'll take them.
All right, Vindia is asking, I'm unclear about what value add is here. How is Finial adding value to industrial buildings? She specifically says unoccupied buildings.
Yeah, great question. So what we consider the value add opportunities are really deals that have not they don't have long-term leases in place, right? So there may be a vacant building that we're acquiring at a very attractive price that, once stabilized is worth substantially more than we've acquired it for, plus whatever leasing expenses we had to get it there. And that's really the way that we're creating value. And that second bucket is this short-term stable with value add. And so that's a deal that may have a couple of years left on its lease term. But a lot of leases are far below market today, industrial rents have grown at a pretty significant rate in the last 2 decades. And so when you get to older leases that may have previously been a 5-year lease, it's generally under market by maybe 20 to 25% relative to today's market rates. And so when that lease expires, there's an opportunity to either negotiate with that tenant on a renewal to get them to market that opportunity, or go lease it to someone else that's willing to pay a market rate. And it's really through that strategy, or that portion of the strategy, that we're creating value and growing the NOI of the portfolio.
And I think it's really important to note that the stabilized buildings that we're buying on the front end have the longer term leases, which enables us to go out and buy the vacant buildings. And because we're vertically integrated, our team is out there every day looking for tenants for those types of buildings. But the value add creation is leasing those vacant buildings that really you couldn't go out and buy. There's a lot less competition for that, or short-term buildings for an investor to go buy because of either not having a lease or a really short-term lease. But because we pair it with a long-term stable, we're able to buy those buildings, perform on in-house, and get the best terms possible.
All right, next question is from Glenn, and he says you are in areas where insurance rates have gone up significantly, and he also mentions property taxes in Texas and other areas. How has the rising cost of these expenses affected your business?
So that is such a good question. Thank you, Glenn, for it. It's actually one of the things we love most about industrial real estate, and specifically these buildings, is they're all triple net leases. By that, we have a base rent, and then we have an operating expense escrow that includes taxes, insurance, and common area maintenance, if there is some, if we handle landscaping or anything like that for the tenant. All of that can be passed back through to the tenant. And so unlike multifamily, right? If you own multifamily, you lease an apartment at an agreed upon price, for the year, and that's all you're going to get out of the tenant. In our case, if we get an increase in insurance rates, which has happened a lot in recent times, and property tax values continue to grow, and that's a significant issue, especially in Texas, we're able to pass all of those increases through to the tenant, and it really does not have any dilutive measure or mechanism into our NOI. We continue to collect our base rent, we continue to grow that. And what we've seen is, because the industrial market is so tight, and we'll talk about that a little bit as we get into our target market, but there's so little vacancy in these smaller buildings, tenants continue to absorb that and continue to be happy to sign triple net leases, knowing that they have exposure as that insurance and property tax number continues to grow.
Okay, and one more question, and then I'll let you continue on. Prolette is asking, you showed your track record going back to 2021. Do you have any slide decks that go further back than that?
So this specific strategy really started, I guess it was actually prior to 2021 that we started executing it. It was probably 2016, 2017 when we started acquiring assets. That really was the first iteration that we eventually sold. That was Fund 1. Prior to that, frankly, we were focused on buying multi-tenant assets like everyone else, right? We didn't know this specific strategy was possible. And so we do have a long-standing track record that we can share with the club. And we've continued to find performance since the early days of our launch in 2010. But we gravitated to this strategy really in that 2017-18 period and started acquiring these assets because we felt like this opportunity is unique and gives us a unique degree of maneuverability and flexibility that we really couldn't achieve in just buying or building big multi-tenant assets like we had in previous years. So definitely happy to share our historical track record all the way from the beginning with you. And I think that's also one of the things that is exciting about investing with us as a company that's been around for 15 years doing this, is when you look at our track record of history, you'll see we were producing results in 2010. And that those friends and family that invested with us at that time are still a lot of the same people that are investing with us now. And, since then, we've continued to grow our relationships, and we now have some larger institutions that invest with us. We now have some large kind of high net worth family offices that invest with us. And so that within this venture, there's some significant, check size that's in there. But we also have just some friends and family in there that you all would be investing right alongside of people who have been with us for 15 years. And we really have kind of a no favored nation strategy as it relates to investors. Everyone gets the same deal. So, you have the comfort of knowing that you're investing at the same terms as my brother and sister are, Dylan's father, Zoe's father, our closest family is investing right alongside you in this.
All right. We are starting to get quite a few more questions, but I'm going to hold them so that you can continue going with your presentation, and we'll get back to them in a bit.
All right. So here on this page, we are showing you our current debt terms with Woodforest National Bank compared to 2 other debt quotes that we've received within the market. And what we really want to highlight is how competitive our interest rate is within our current debt facility. So if you'll look at the interest rate comparison chart, this is forecasting the interest rates from all 3 debt quotes that we received over the next 18 months. And as you can see, the blue line, which represents our forecasted interest rate from Woodforest National Bank, which again is based on the 5-year treasury rate plus 200 basis points, is about 150 to 200 basis points lower than the other 2 debt comparisons that we received. It's also important to note that this 18-month forecast that I'm showing, this is our deployment period. So this is the time when we're actually in the market purchasing and acquiring buildings. And each building it's locked in fixed interest rate for the next 5 years. So this is the most favorable time for the fund to have lower interest rates and be able to lock those in.
Yeah, we think that slide's important just to touch on that, really, because I think the debt facility is a unique advantage that we have in today's market. As you all know, financing is hard for a lot of buyers right now. But because we have this long-term relationship with Woodforest Bank and they have executed this strategy, 5 previous times with us, they get it. And we were able to replicate the terms of what we had in our previous agreements with them, which really, frankly, is below market. The 5-year treasury plus 200 basis points is far below what I think we could get from any other lender, and I think any other operator can get. And that really is something that we leverage to maximize the value we create here.
All right, and then to talk a little bit more about our equity piece. As I previously mentioned, we are targeting a total equity raise of $16 million, of which 90% of this, for $14.4 million, we are looking to raise through LP investors. And then the remaining 10%, which represents $1.6 million, will come from GP investors, which is Finial Group. And below, we have our waterfall on the screen, which essentially shows you how all distributions and profits will be returned back to all equity investors. So for example, in the first row, we have our preferred return level, which shows that up to a 10% IRR, all distributions and profits will be split 90% to the LP investors and 10% to the GP investor, which is pro rata share of original equity invested. On the next line, we have our hurdle 1, which shows that all profits and distributions above a 10% IRR and up to a 15% IRR will be distributed 75% back to LP investors and 25% back to the GP investor, and so on. And it's really important for us to note here that we intentionally structured our waterfall this way to make sure that GP interests are directly aligned with LP interests. So the more successful the fund is, the more successful our LP partners are, and the more incentives there are for the GP as well.
And I think it's also important just to note that we already have commitments for about $10 million in LP investments. So we're seeking an approximate $5 million remaining number. But we already have a substantial amount of LP equity raised. That money really came from our existing relationships with family offices and friends and family that just have invested with us before and continue to. So we're already, 3/4 of the way there and very confident we're going to close the gap and would love for you all to be a part of it.
And now I'm going to pass it on to Dylan to talk about our target markets and target buildings.
Thank you. So as we look to build this fund tenant by tenant and building by building, one question that we always get is there enough of this type of product in the markets that you're operating in? And so we do a lot of studying in how much activity is in a certain market. What are the driving factors to it? We track U-Hauls, how many people are moving to these cities. And this is a great slide. I've got one for each city. I'll go over this and then the aggregate number. So as we look at Dallas, if you Googled or got into some program that looked for industrial space, how many square feet is there? You'd find that Dallas has about 1 billion square feet of industrial space. Well, we're trying to buy our freestanding industrial buildings. So now we're taking out the dock high distribution centers, the big Amazon facilities, and we're saying how many of those are just freestanding industrial buildings. And you'll find about 584 million square feet exist in the Dallas Fort Worth market. When we look at buildings that we'd buy for our fund, it would be the size would range from 10,000 to 100,000 square feet. So that drops that number down to about 147 million square feet. And then what we do at Finial Group is, because we've been doing this for so long, we know what tenants and how tenants use buildings and what to look for in these types of buildings. We want 4 walls and a roof. And so we're not too weighted in one direction to a specialized building that if a tenant left, it would take us 2 years to lease. What we want is, again, 4 walls and a roof, something that we have age requirements and we've got dock high requirements. We've got a lot of factors, which I'll go through in another slide, of what we look for. So we call them the Finialized buildings. So we narrow down out of 1 billion square feet of industrial space to 107,000 square feet or 107 million square feet in the Dallas market. Well, if I took the aggregate of all 5 markets that we're in, that's again, Houston, Dallas, San Antonio, Atlanta, and Nashville, really the total square feet for industrial space is roughly 3 billion square feet. And if we broke that all the way down, like I did with Dallas, to just the Finialized style buildings, there's about 267 million square feet of this type of product in the markets that we're currently operating in. And I think that number is really important to point out, because what we're seeking in this fund is to find the right 300,000 square feet of buildings. It's going to be 15 to 20 buildings that we'll put in this fund for that $30 million. So what we're doing is we're looking at a lot of buildings and really looking at, do we meet the standard we have for diversification across location, tenant mix up, how usable the buildings are, how new the buildings are, and that's what we're aggregating into the fund.
That's actually a good point here to bring up 2 questions that were answered, if I can jump in.
Sure.
Yeah. So we have Prolet, who's asking, what's the target length of new leases?
So that does range. So when we talk about stabilized buildings in the stabilized bucket, the range is going to be about 5 years to 10 years, generally, I'd say. If we're looking for the value add buildings, the short term, what we call short term value add, it's going to range from anywhere from a couple of months to maybe 9 months of lease term or a year of lease term, which we know during the hold period, we're going to go back out, market the space and re-tenant that building, and we would re-tenant to a 5, 7, or 10-year lease. So all new deals that we do, we generally are really pushing for that 5 to 10-year range. Any renewals that we have, we are pushing back up to that 5 to 10-year range.
Okay, and Manjanatha is asking, what type of tenants occupy these buildings, and do you have any cash flows apart from the leasing contracts?
Yep, great question. So the types of tenants that are occupying these spaces is we spend, again, a lot of time doing market research of where people are moving. So if you think of all the houses that are going up in these 5 growth markets, you've got construction products like roofing supplies, insulation, you have electricians and plumbers, and then you have service industry people like the landscapers, the pool cleaning groups, all the way to flooring companies, painters, all have space in this. If I think about some other types of users that we've had, equipment share, equipment rental businesses have occupied a couple of our buildings in the past. And then we've also gotten into some of these buildings will have big heavy equipment where they're CNC machines and they're creating certain parts or certain pieces of a part that then later go to the oil and gas industry or go into the car manufacturing building or a plethora of other industries. So it does, the targets that we're seeking, again, being 4 walls and roof, as long as there's growth in that area and there's need in that area, we can be pretty flexible about the types of tenants that we lease to. Now, it's very important to us that we're not so overweighted in a portfolio in, say, oil and gas, because if that is a cyclical business, we just don't want to be on the wrong end of that business when we have other buildings to occupy. So we like the diversification of having some in the construction world, some in the oil and gas, some in the small parts distribution. But that's the types of buildings we're targeting. And then the last piece is the e-commerce business really has continued to grow. Amazon's big facilities, the 2 to 5 million square foot facilities, they keep getting pushed further and further out from the center of where people are living. So Amazon has contracted with what we call micro fulfillment centers. And these are warehouses that we would generally own. They're going to be 20 to 70,000 square feet that will have the paper towels, the items that you could order and be at your house in an hour or that same day. So those have to be closer in and more infill. They're going to be a little bit smaller, but they have contracts out with Amazon. A great example of that is I ordered a book on the internet. It was a used book from Amazon. That's originally what they were doing. But it just so happened we were under contract here in Houston on a property, and I noticed that was the address that it came from. And it was pretty amazing to see that they cover all of Texas and New Mexico of used books out of that one facility, which was 50,000 square feet.
All right, I'll let you go on. We don't have any other questions that are immediately on this topic, but we do have a few others, and so we'll hold them till the end. And just to let you know, we have 14 minutes left.
Perfect. And I can make this one quick. So our approach is our team goes out and we identify the buildings, but we do that by our team going out and canvassing each of the markets. So all of our team members are out cold calling door to door. Every single building that we've bought for the fund has been completely off market. So this isn't being marketed by a real estate company and we're the ones that paid the highest price for that building. We are in the markets every day talking to owners about their buildings and coming up with assets that fit our parameters and what we're looking to buy. And to date, I think it's really important to note that of the owners that we've been actively cold calling for this venture alone, we've talked to over 3,800 owners, which has led to 67 meetings, in-person meetings, and 25 properties that we began to underwrite. That's important to note that 25 properties is about $60 million or about 520,000 square feet. Again, we're looking for 300,000 square feet, and that's going to be 15 to 20 buildings. So we've got a very strong pipeline of assets that we are going through and really making sure that we're getting the best ones that are going to achieve our returns or better. And to date, we do have 4 buildings under contract. That's roughly 86,000 square feet and is about $14 million under contract today. And then real quick, I can show this slide. Here's a couple of buildings that we do have under contract right now for this venture. And like I said, you can see the equipment rental style business that's here. They're generally going to have a little bit of warehouse space, but generally you're looking for that outside storage where they're going to have the equipment. When you look for Action Supplies here is really distributing ceiling tiles and insulation for commercial buildings. So they've got dock high needs, and this building has that, and they've expanded into that building, and we really like that one. This building over here on the bottom left is what we say is your general machine shop style building. This one we are buying with a long-term tenant in it, and they're repackaging rice from the rice mill that's right next door. And then the bottom right building, this again is more of an iOS style building. The picture doesn't do a great job because it does have 2 acres of outside storage. And so you generally have a shop where you've got small parts that are being put together, trucks and things that are taking that to the location. And that's why you need those yards. We look at, here's 4 other additional buildings, but really wanted to point out some key features that we look for. Not all buildings are the same. So if you look at this building, it's definitely taller than the other buildings. It's a higher clear height, which is important if you're racking and distributing properties. So you do want the dock high, which are the 4-foot doors on them, so you can back the 18-wheelers up to it. You're going to have rack product that you're going to want to get in and out of those buildings. If you look at the top right, that's generally going to be your pop-out office. And the reason you do that is because this is a crane building. If you've got a big overhead crane that's moving back and forth, you don't want to be shaking all the desks in the office. And so these are manufacturing guys with CNC machines that are putting out product. And then the other two, the bottom left was a print shop. So it was 100% air conditioned, but it was putting out all the printing material that you see when it comes to flyers or government contracts. And then the top left is an example of one that could be manufacturing or distribution, but these are all styles of targeted buildings that we're looking for. So with that, I'll turn it back over to Keith.
Yeah, so to wrap it up, in summary, this is an opportunity to invest in a tested strategy that we're now in our 7th iteration of. We aim to acquire within this venture 15 to 20 single-tenant freestanding industrial buildings that are really your last mile distribution and light manufacturing kind of buildings. We are aiming to deploy about $36 million, really with the goal of combining strategically those stabilized assets with the near-term value add and vacant lease-up assets. And then ultimately, upon leasing the assets up, optimizing NOI of the portfolio, exiting in one large institutional sale, and creating value through this cap rate compression idea of buying in this fragmented and efficient market and selling in an institutional efficient market. With that, I'd like to turn it over to any questions you all may have and use the remaining of the time for that.
Yes, we have a question here from Glenn. He's asking, are you planning on raising all of the equity at the onset of the fund, or will there be capital calls periodically throughout?
Yeah,
what is your hold time for the buildings?
Perfect. Great question. So what we have done is we've already called 50% of the capital from the commitments we already have in, and that's how we have assets under contract that will be closing really in the coming weeks. We have a planned capital call for those initial commitments to happen in December, probably just before the end of the year. So we'll call in the remaining amount of that. So there will be for new investment capital for this last $5 million, there will be one capital call where we'll call that capital, somewhere within the next 60 days after commitments are come in, and we'll do one capital call period. Within this strategy, I think it's also important to note we've never had an unplanned capital call. We have never had to go back and ask for more money from our investors. No one likes that. We know no one likes that. We're all, we invest in other kind of opportunities, and you want to be in for the amount that you wrote the initial check for, and you don't want that surprise email saying that you somehow owe more because the operator made a mistake or the market or whatever the excuse is, right? And what we love about this strategy is you have this finite level of control individually per asset that really helps you mitigate ever having to do that. So if you had an asset that for some reason didn't lease as quickly as you thought, you have the ability to spin it out and sell it out of the portfolio and then go buy something else to replace it. And so you have a degree of control really to keep from having to capital call investors. And I think that's an important part.
And the whole period is we deploy the capital in a 12 to 18 month period. So we're buying buildings 12 to 18 months. And then we have a period of time where we're doing our lease up strategy. Sometimes early on, we'll buy a building, we'll begin to market, even though we're still deploying capital, we'll get a lease done. It only helps the venture, and we've done that several times as well. And then we'll be able to loop another value add in. But that whole period is 12 to 18 months of deployment. Then we have a period of about 9 months where we're doing our lease up strategy and value add creation, and then really look for the right time to bring to market and sell. And so really what I'd say is we're 3 to 5 year hold period in total. Of the ones that we've gotten full cycle in, they've all been under 3.5 years. And so that's a good barometer of the timing of it.
And that question actually perfectly dovetails into another question that Manjanatha has asked, and that is, what exactly are your sell criteria? How do you determine when the time is right to sell?
Yeah, so in our business, obviously it's cyclical, right? There are times when massive amounts of capital are coming in, And there are times where everyone else is kind of on the sideline. We try to be opportunistic, and in times like right now, where a lot of big capital is on the sideline, we want to be as aggressive as possible and buying at really attractive pricing, which is what we're doing today. And we know that the markets will turn. We know that we can lease these assets and produce cash flow in the interim for that hold. And then ultimately, we want to be positioned to sell when those capital markets get frothy. Which, yesterday, or not yesterday, but Wednesday, the interest rate reduction of 50 basis points is really meaningful in our business to our buyers. And the expectation that perhaps more rate relief comes in the near future is very promising. And we believe cap rates will continue to trend down. So we think that we're in this narrow window where right now we can still be really aggressive and buy at good pricing, but probably by, end of Q2 next year, the market's getting pretty frothy again, and there's a lot of buyers coming back into the space. And at that point, we'll be very intentional about selling when we think everything is at good multiple pricing. And that, there's a time to buy and a time to sell. And we feel like that time to sell will be coming then. But right now we're focused on really taking advantage of the current buy side opportunity.
And because of our debt and our track record with the lender Wood Forest Bank, again, the 2 points above the 5-year treasury, which is pretty unheard of right now. We've consistently been getting that from them. But because of how we line up our debt with fixed assets going into a project, if it is a little bit longer of a hold time, the great news is we will be doing quarterly distributions once the assets have been deployed. And so that's really important because when you look at over the past couple of years with the rising interest rates and people not having fixed debt in place, a lot of investments stopped giving quarterly distributions. And we've continued throughout that whole period on all the funds, giving out the quarterly distributions as projected and planned.
All right. And then probably next to last question here, a couple of people are asking about your fees and what your fee structure is.
Yeah, so it's a good question. So we have a vertically integrated structure, as we mentioned to you. So what we are able to do is, there's kind of a standard market fee that typically gets paid to a leasing broker for handling the leasing side of the business. And there's a standard market fee that is for the property management services. We're able to capture those fees because of our vertically integrated model. And because of that, we're able to have an extremely low asset management fee and really not make our money on asset management fees. Truthfully, when you'll see as we can share the PPM with you, we really only make money as a company when we ultimately sell these ventures and promote. And that's when our investors are getting their capital back plus return, and we're all winning alongside of each other.
Okay. And I will say again to everybody here that Finial Group and this investment is a club fund investment. They're club fund speakers. And so I'll be sending out an email afterwards to see if people are interested in putting their capital into this project. And we will have a capital raise that you'll see via your email. So if you're interested, go ahead and respond to that. And based on that response, the club fund will allocate a certain percentage of capital to put into Finial Group's investment. Minimum investment to Finial. So Glenn, you want to know if you go direct to them, what the minimum investment is? Yeah, so I'll ask that question.
Yeah, so minimum investment to be direct with us would need to be at least $100,000 commitment. But we welcome commitments of all size to invest through the fund, where you guys can come to us as one partner. And we're really hoping to continue to grow and expand the relationship with the fund in time. And so we view this as our opportunity to go show you how good we can be. And hopefully we're talking about the next iteration when that time comes.
And are you only accepting accredited investors?
It is an accredited investor requirement, yes.
Okay. I think we've answered all the questions. Oh, one just came up here. Actually, here's a question that we didn't get to. How has COVID and the after effects of COVID affected your market?
Yeah, that's a great question. COVID was actually very good for the industrial market. It was obviously a terrible event for humanity and all of us globally, but from an industrial aspect, it actually boosted demand in a substantial way. It took a generation of people like my parents and grandparents that probably never would have bought anything online. And because they all were concerned about exposure, they started buying everything online, right? And everything that people are buying online has to come from a warehouse somewhere. And these are the kind of buildings that this stuff comes from. And then on the manufacturing side, there was so much supply chain disruptment because a lot of our manufacturing was being done overseas that a lot of big manufacturers realized that's dangerous. And if we want to control our supply chain a little better, we need to have some capability, and our vendors need to have some capability of domestic manufacturing. And so those two aspects have driven demand in a very meaningful way. And we believe that's a lasting way. We don't think that that's like a short-term win, but we think that this is here to stay in terms of demand. And these are well-located assets that we're aiming for that are really in areas that you just can't build a lot more of this product. So we think that continues to push rents up.
All right. I wanted to thank you very much for coming here. Could we have everybody here take themselves off of mute and thank the Finial group for presenting to us today?
Thanks, y'all.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you all for joining us. And if there are any follow-up questions, feel free to direct those to Daniel, and we will make sure that they're all answered. You guys are always welcome to reach out, and we're always happy to jump on a call or respond back to emails.
Thank you.
Thank
All right.
you.
Thank you, everybody. And as the club voted, next week we will have a club discussion. So come with your success stories, your failure stories, your questions, your thoughts, and it's just going to be a free and open discussion next week. I'll be gone, and Ryan Olson will be moderating. Have a great week, everyone.
Thank you.
Thank you.
Cool,
Thank you,
Daniel.
you too.